Dear students, in the previous session, we discussed what are the ethical issues faced by multinational corporations and businesses that operate at the international level. However, in this session, we will concentrate on why ethical practices are imperative for all kinds of businesses, big and small. Considering the growing influence of business in the economy and the lives of the public, they have a responsibility to run their operations with a focus on transparency, fairness, and honesty. The topic of this session is business ethics and corporate governance. Let's look at the learning objectives of this session. At the end of this session, you will be able to understand the following topics: the importance of ethical practices in a business, and the concept and need of corporate governance. Now let's look at what exactly is the meaning of business ethics. Business ethics is the application of general ethical ideas to business behavior. It is based on the principle of integrity and fairness and concentrates on the benefits to the stakeholders, both internal as well as external. Stakeholders of any business are the people who are impacted by the business operations. These include those individuals and groups without which the organization does not have an existence. And stakeholders might include shareholders, creditors, employees, customers, dealers, vendors, the government, and the society at large. Therefore, businesses need to balance the interests of all these stakeholders and simultaneously also earn money or profits. Now let's look at why or what is the importance of business ethics. A business organization competes in the global market on its own strength, in particularly the strength of its human resource and the goodwill of its stakeholders. Value-based management and ethics that an organization uses in its governance enables it to establish productive relationship with its internal customers and lasting business relationship with its external customers. In the long run, the company is able to create a positive image about its operations and is able to create a relationship with all kinds of stakeholders, which are essential for doing successful business in the society. Real type situations, that is, Tata Steel and Infosys, show that use of ethical practices in business creates high returns for companies. And therefore, companies should not only conduct ethical practices, they should not only follow business ethics in order to satisfy the minimum requirement, but also make it part of their strategic decisions. Now let's look at what are code of conducts and ethics for managers. Managers must observe the following ethical values while performing their duties. They should follow impartiality, responsiveness to public interest, accountability of their action, honesty, transparency, especially when it comes to information disclosures, and integrity of their action. Here we introduce a new concept which is called as corporate governance. Corporate governance is or it addresses the problems that result from the separation of ownership and control. Corporate governance is especially important for company form of business because the owners of a company are its shareholders who are not involved in the day-to-day running of the business. From the angle of developed versus developing countries, in developing economies, one must look to supporting institutions, for example, shoring up weak judicial and legal systems in order to better enforce contracts and protect property rights. Now, if we look at the narrow versus broad perspective of corporate governance is defined narrowly as the relationship of a company to its shareholders, or more broadly as a relationship to society. Therefore, corporate governance in its true form is not only the responsibility which directors of a company have to its shareholders, it's also the responsibility of the directors to the society at large. There could be certain issues which can crop up when following the concept of corporate governance. Now, let's look at them. First, distinguishing the role of the board and the management. Second, composition of the board and related issues. Third, separation of the roles of the CEO and the chairperson. Fourth, should the board have committees? Appointments to the board and directors' re-election, directors and executives' remuneration, disclosure and audit, protection of shareholder rights and the expectations. Ninth, dialogue with institutional shareholders, and also should investors have a say in making a company socially responsible corporate citizen. Now arises the question, what is the relevance of corporate governance? Corporate governance ensures flow of capital for combating corruption, stakeholder protection, ensuring industrialization and economic prosperity. It also improves shareholder confidence. It enables well-governed companies and they get a premium for their stocks. It enhances the company's competitive advantage, prevents fraud and malpractices. Corporate governance can also protect shareholders' interest. It can create additional shareholder value over time. Corporate governance enhances the valuation of an enterprise and it ensures compliance of laws and regulations. In summary, in this session, we have discussed about the idea of business ethics and code of conduct that must be followed by managers. We have also discussed the issues of corporate governance and its relevance in the current time and age.